This episode discusses a counterintuitive phenomenon. Why haven't U.S. Treasury bond prices, especially long-term ones, risen during this round of Federal Reserve rate cuts? In fact, they've fallen. If the stock market is the part of an iceberg that sticks out of the water, then the Treasury bond market is the larger part beneath the surface. Not only is it larger, it's also the cornerstone of the entire capital market. On August 22, 2025, in Jackson Hole, Wyoming, central bankers and economists around the world waited with bated breath. Federal Reserve Chairman Jerome Powell took the podium to deliver his highly anticipated annual address. His words, like a pebble dropped into a calm lake, instantly stirred 1,000 waves in the market. Powell acknowledged that the balance of risks in the U.S. economy appears to be shifting. He specifically highlighted concerns about the labor market outlook, arguing that despite apparent stability, underlying risks are rising and could even quickly manifest themselves in the form of a sharp increase in layoffs and rising unemployment. Wall Street immediately understood the underlying message: rate cuts. The market went into a frenzy. The Dow Jones Industrial Average soared 925 points, and gold prices rose $35. This seemed like another classic bad news is good news scenario. The worse the economy, the more likely the Federal Reserve is to flood the market with liquidity, and the higher the prices of risky assets. However, amidst this jubilation, a discordant voice emerged from a corner of the financial market. That was the U.S. Treasury market, known as the anchor of global asset pricing. Data showed that the yield on the 2-year Treasury bond, which is most sensitive to expectations of rate cuts, fell by 11 basis points in response, a significant reaction. Strangely, the yield on the 30-year Treasury bond fell by only 4 basis points, showing an unusually indifferent reaction. This is more than just a trivial discrepancy in the data. It is a signal, a crucial one that could foreshadow profound changes in the future market landscape. This leads to the core topic we will explore today. Given global expectations that the Federal Reserve is about to begin a cycle of rate cuts, why does the trend of long-term Treasury bonds seem to no longer obey the Fed's orders? To understand this strange phenomenon, we first need to examine a chart. This chart depicts the trajectory of U.S. Treasury bond yields of various maturities and the Federal Reserve's federal funds rate from the beginning of 2024 to August 2025. Let's interpret this chart step by step. The relatively flat line in the chart represents the federal funds rate, the policy rate over which the Fed has direct control. We can see that starting around mid-2024, this line begins to trend downward, marking the official start of the Fed's rate-cutting cycle. In the early stages of the rate cuts, everything followed textbook economics descriptions. Yields on 2- to 30-year Treasury bonds, which represent market expectations of future interest rates, tracked the Fed's progress, falling steadily. But then something strange happened. As the Fed continued to cut rates, Treasury yields, particularly those on 10- and 30-year bonds, which represent longer-term economic expectations, briefly dipped before unexpectedly turning upward, embarking on a rally that defied the Fed's policy direction. By the end of 2024, trends had further diverged, with the 2-year Treasury yield diverging from the trend of other long-term bonds and experiencing a brief decline. The 30-year Treasury yield, in particular, remained remarkably resilient, even continuing to climb when the 10-year yield temporarily stagnated. This completely defies conventional market logic. Normally, when a central bank lowers short-term interest rates, long-term interest rates should also fall, lowering borrowing costs across the board and stimulating the economy. But now, we see a dichotomy. The Federal Reserve is cutting rates to prevent a recession, while the long-term Treasury market, which determines the cost of mortgages and long-term corporate financing, appears to be turning a blind eye. What does this mean? Is the market going crazy? Or are bond market traders, the so-called smart money, seeing something that ordinary investors don't? Are they using their hard-earned cash to issue a warning to the Federal Reserve and, ultimately, the world? To unravel this mystery, we need to delve deeper into this ingrained understanding. First, we must dispel a common misconception: the notion that the Federal Reserve can control interest rates. The truth is, the Fed can directly control one and only one interest rate, the federal funds rate, the overnight interbank lending rate. It can influence short-term interest rates through open market operations. However, its influence on long-term interest rates, such as 10-, 20- and 30-year maturities, is indirect and limited. The true determinant of the direction of long-term interest rates lies in the market itself. Millions of investors around the world vote with their money. Their collective decision reflects their confidence in economic growth, inflation, and, most importantly, the U.S. government's ability to repay its debts over the coming decades. Market analyst Mike Shedlock aptly points out, the Fed can only control one thing at a time. It can lower the federal funds rate, but it cannot control how the economy performs at that rate. Similarly, it cannot fully control the direction of long-term interest rates. So, what powerful forces are counteracting the effects of the Fed's rate cuts, or even working against their own will? The answer lies not in the Federal Reserve boardroom, but in the budget proposals on Capitol Hill. In the financial world, there's a term called bond vigilantes. This refers to a group of bond investors who, when they believe a government's fiscal policies are irresponsible and could lead to future hyperinflation, protest by selling their country's bonds. This sell-off causes bond prices to fall and yields to rise, forcibly pushing up the government's borrowing costs and thus punishing the government's profligacy. For a long time, these bond vigilantes seem to have disappeared due to the strong global demand for U.S. dollar assets. But this chart from 2025 suggests they may have returned. What they're staring at is a sharp deterioration in the U.S. fiscal situation. First, there's runaway government spending and debt growth. Data shows that the U.S. national debt has reached a historic high of $37 trillion and is increasing at a staggering rate of $1 trillion every 150 days. This scale of deficit is unprecedented in peacetime. Second, there's enormous pressure on the supply of government bonds. To finance its massive fiscal deficit, the U.S. Treasury must continuously issue new bonds. This is a simple supply and demand equation. When the supply of a commodity becomes infinite, what happens to its price? It inevitably falls. And for bonds, falling prices mean rising yields. Finally, there are concerns about future inflation. In his Jackson Hole speech, Powell himself acknowledged that the impact of tariffs on consumer prices is now clearly visible and is expected to continue to accumulate in the coming months. The bond market's initial reaction to this statement wasn't, "Oh, the economy is going into recession, buy long-term bonds for safety," but rather, "Oh, the government is printing money and imposing tariffs to drive up prices. Future inflation may not come down." A reader named Malcolm X commented on Mike Shedlock's article, his comment hitting the nail on the head. It's interesting that we're facing a situation where interest rate cuts and tariff inflation are happening simultaneously. This reminds you of the mid-1970s when the Fed made a similar shift, which ultimately led to higher inflation later in the year. This is the core reason why long-term Treasury yields refuse to fall. Bond investors, especially pension funds and insurance companies that need to protect their capital for the next 30 years, aren't concerned with whether the Fed will cut interest rates by 25 basis points or 50 basis points at its next meeting. They're concerned with how much purchasing power their dollars will retain 30 years from now. When government spending spirals out of control, debt snowballs, and inflation expectations rise again due to policies like tariffs, rational long-term investors will inevitably demand higher yields to compensate for the inflation and credit risks they'll bear. Thus, the strange phenomenon we're witnessing is essentially a tug-of-war between two markets. On one side, the stock market is excited by the word rate cut, as it implies more cheap money for speculation in the short term. On the other side, the bond market sees the increased government debt and higher long-term inflation risks behind rate cuts, and therefore expresses its distrust by selling. The result of this tug-of-war is what we see. Short-term interest rates follow the Fed downward, while long-term interest rates are held firmly in check by the massive gravitational pull of fiscal deficits, or even pulled upward. This isn't just a technical exercise in the financial markets. It's a vote of confidence. The bond market is telling us, in the clearest terms, that it has cast a vote of no confidence in America's long-term fiscal discipline. So, how will this confrontation between the Fed and the market evolve? What tools does the Fed have to regain control? What political dynamics are at play here? We'll continue our discussion in the next episode.